about Petrizia, which is a leading European real estate investment manager. And I'm going to talk to you about the European real estate market, the economic background, and our view on the current opportunities and risks within European real estate today. I've worked in the real estate industry for the last 31 years, and for the last 15 years at my current company, Petrizia. Now, I'm going to talk a little bit about Petrizia to start with so you get the context of the company and the scale of the company. As you can see from this slide, Petrizia is a manager of scale with 41 billion of real estate assets under management across Europe. And that's managed by 850 professionals in 19 local offices. And on average, over the last 3 years, we have transacted over 8 billion of deals each year. So hopefully that illustrates we have access to transactions and interesting opportunities for investors. Now, Petrizia believes that local knowledge is the key to both sourcing and successfully managing European assets. And that is why we have 19 local offices with lots of people on the ground in transactions and asset management. And we think that's an important advantage and a key requirement for investors looking forward. Now, these local offices are complemented by our 5 global investor hubs, a key one, of course, being Seoul, which we have operated since 2013. Just to put in context the assets under management within the business, as you can see from the slide, we are diversified across all countries in Europe. However, clearly, Germany is the largest market exposure, and that is because the history of the company is that it originated in Germany. So Germany and UK are 2 largest exposures within Europe for funds under management. We cover all styles of investment, but again, the key styles for us are core plus, and value add. To date, our opportunistic investment has been very low, and largely that is because we consider it high risk with no guarantee of reward. The company is a listed company in Germany, and it is majority owned by the founder and CEO, Wolfgang Egger, and you can see his photograph on the bottom of the chart. So hopefully that set out the credentials for how I'm able to talk to you about European real estate today. First slide is a slide to say why real estate is important in an investor's management portfolio. Now, we look back at various academic studies going right back to 1984, and it's quite interesting to look at their suggested exposure to real estate in a global portfolio. As you can see from the chart on the right-hand side, they suggest the average for real estate exposure should be 15%. 15% of weighting. Now, in my experience, as I've said, 30 years, the clients that I've worked for and the business clients, it's typically been more like 6% to 12%. However, one thing is very clear today, is that real estate exposure is growing in investors' portfolio. Right, we can't talk about European real estate without thinking about the economic context, because clearly that dominates our strategic thinking. So let's try and provide some context today. You have 2 charts on this slide. The first one on the left-hand side shows economic growth in the Eurozone, measured by GDP, and it's quite clear that over the last year, the economy has slowed. The Eurozone economy has slowed. We are not immune to trade wars stoked up by Trump, and we are not immune to politics, for example, Brexit in the UK. However, inflationary pressures are low. You can clearly see that on the chart on the right-hand side. Eurozone core area CPI, circa 1%. Materially below US levels. With low inflation, we expect interest rates to remain lower for longer. And as a consequence of that, we currently consider that the risks of recession are being overstated. For real estate, we see this economic environment as supportive, and that is reflected in current pricing. You'll see from this chart, it's very clear. Historically, yields are very low. We have used London offices and Munich offices as a proxy for the general market, and we have benchmarked that against government bonds. So yields are low. Everyone has seen that. There's a lot of comment in the press that prices are very high, possibly at the top of the market. However, what you also see from this chart is that the margin between real estate and bonds is attractive. It's one of the largest margins for the period since 2000. And that, frankly, is why there is such strong interest in real estate today and why pricing is strong. Real estate remains a relatively attractive investment class. So not surprisingly, transaction volumes have been growing. You can see on this chart clear growth since 2014 in all of the main markets. You can also see it slowed a little last year, was impacted by global views and commentary. You can see from this chart that Germany and the UK are the two biggest markets in Europe. But you can also see the top element of the chart in blue, rest of Europe. That has grown over the last few years, and that reflects investors seeking yield in Central Europe and Southern Europe. So, for example, Poland, Czech Republic, Spain, Portugal. Investors searching for yield outside of core markets. Now, don't be scared by this chart. It looks a bit busy and complicated, but actually the message here is very simple. Despite the low cap rates in Europe today, on a relative basis versus bond yields, we would argue Europe provides a more attractive return than both North America and the Asia-Pacific region. If you look at the dotted red line, just about see it, sorry, this red mark is not very good. You can see that the margin is much greater in Europe compared to North America. So we think there are good reasons to support real estate investment in Europe. However, it's not all about economics. As a long-term investor, as many have commented today, investment should be considered on a long-term basis. And for that reason, we need to be aware of and understand the implications for real estate long-term trends. Now, I think most people would agree that increasing population in urban areas, otherwise known as urbanization, is one of the key trends. Urbanization leads to displacement of people from being pushed out of areas into having to move to poorer areas, and those areas becoming improved, which we call gentrification. Where areas gentrify or improve, there is clear potential for rental growth. urbanization supports real estate. There are two charts on this table. The one on the left-hand side, we have highlighted Berlin office market. Actually, it's GDP growth for each of the major cities in the various countries, and you can see that Berlin GDP growth is greater than German GDP growth. That is reflecting the growth in population and dynamism in Berlin. And what does that mean for real estate? You can see that on the chart opposite. This is growth in rents in submarkets in Berlin over the last few years. And you can quite clearly see strong rental growth in all of the submarkets in Berlin. So a good example of urbanization and gentrification driving performance and rental growth in real estate. But what is the real reason for that rental growth? Well, it's simple economics, demand and supply. On the left-hand side, you can see a chart that is take-up of offices in the Eurozone. And again, it's very clear to see strong growth in take-up. You would expect strong growth in take-up to be matched by an increase in supply, the response of supply to the demand. However, what we have seen in Europe is the opposite. We have seen supply reduce over the period, so we have a strong imbalance between demand and supply, the net result being rental growth. You can see on this slide, this is office rental growth across Europe for the last 2 years. Exactly that happening. Strong demand, limited supply response results in rental growth and performance for real estate in Europe. Now there are two outliers on this chart. The first one is Berlin on the left-hand side, which I've talked about. The second one is central London on the right-hand side. And there's a very simple reason for that. It's called Brexit. But it's not all about offices. Arguably, logistics is at the top of most investors' pick list or wish list in Europe today. Logistics is a clear winner from the technology changes and rising internet sales. You can see on this table on the right-hand side the consistent growth in demand and take-up in logistics. And you can see on the right-hand side the impact that has on rental growth, which will drive through and deliver performance for investors. The growth, not surprisingly, has been strongest in those last mile, large urban logistic locations. But whilst logistics has been a clear winner of the changes in technology, retail, on the other hand, is seen as a loser from the changes to date. This table shows the change in investors' sentiment, demand for retail over the last 2 years. And you can see that as of Q1 this year, it was negative investor sentiment and demand for retail across all of the jurisdictions within Europe. Now, you might be forgiven for thinking that retail was all bad, but I'm here to say all retail is not bad. Retail that is convenient, retail that is dominant, retail that is food anchored will remain an important part of retailers' distribution chain and will offer robust income/cash flows. However, in the near term, we are experiencing and expect further turbulent pricing and sentiment probably to weaken. But it may well be that the next big opportunity within the property sector is retail, because on relative pricing, it may suddenly become attractive compared to the very low yields for offices, logistics, and residential. We need to watch that space. So finally, residential sector. Again, a very popular sector. You can see that on this chart. Consistent growth in volumes transacted, which equates to investors' search for product and building their portfolio. It's a low return product, but it carries lower risk. There is clearly strong appetite for residential across Europe today. The biggest market for residential in Europe at the moment is Germany, followed by the UK, but our expectation is that all markets will benefit from the growth over the next 2 to 3 years. So, thank you for your patience. I'm almost at the end of my presentation. Just like to leave you with some conclusions. The first one is important. We foresee an economic slowdown. We know we're already seeing it, but we don't consider there is a recession around the corner. Of course, Donald Trump can change that, and so can our British politics. Yes, pricing is at record low yields, but that is because the demand and supply occupier fundamentals are very healthy. Strong demand, very low supply. Supply remains low because there's been no supply response. Neither equity or debt is attracted to the returns. So that means there's rental growth potential. Rental growth potential should drive performance. But to unlock that, you need strong local knowledge. Thank you for listening.